All right. Today is Sunday, the 19th of November. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. Let's begin with my favorite event of the year. If you happen to be new, I'm saying that sarcastically. And that is the F1 race here in the city of Las Vegas. I told you it's garbage. The whole thing is a mess. And valuations matter. Not just in the stock market, but also when you buy tickets ahead of time because you think everybody's going to stampede and you don't want to wait for the last minute and you overpay and then you look like a douchebag at the end. Well, that's exactly what happened here, folks. Just a few hours before the race began, they were handing these tickets like those stripper cards. When you walk the strip, right, you got the guy, smacking his hands with a bunch of fake cards, probably, numbers that if you call, the cops will show up to your room, that kind of thing. But they were handing these tickets like hotcakes. All of a sudden, everybody got tickets. Everybody bought for their corporate events or whatever, and then they realized that nobody's showing up. It's really cold outside, and oh, by the way... somebody hit a manhole and the whole race stopped. You know the deal. So all of a sudden we got tickets all over the place. And I got some people who are like, hey, you want to go to the F1 race tonight? We got some tickets. I'm like, no, but I'll go to the bar and see if somebody wants to take them. You go to the bar, you hand them, hey, you want a ticket to the F1 race? Nope, no thanks. I'm not going to be within a 5 miles radius from the strip until the stupidity is over. That's how the locals feel, folks. But thankfully, it's over now and never again. Hopefully, never again. What's up with this F1 anyways? Bunch of rich folks show up in different cities around the world to watch cars chasing each other. Doesn't make sense here. I think there is an Epstein-y angle to this whole F1 thing. I think it's a cover for human trafficking, but anyways, you know what I was thinking about before making this video? I was reading the Wall Street Journal, and I stumbled into this article by James McIntosh, and he says, what's behind the market's wild overreactions? What is he talking about here? He's talking about why is the market so excited at the hint of any good news, or let's just rephrase that, bad economic news, and overreacting to the upside just with the assumption that somehow the Fed will be done with raising interest rates and that's somehow a good thing. And of course, James is talking about the reaction this week to the CPI that we got, which was supposed to come out at 3.3%. It came out a tick lower at 3.2%. And oh, by the way, the core CPI at 4%, double the Fed's target. But the market took a victory lap based on this reading. And wait a minute here, do you realize that 4% is still double the Fed's target, number one? Number two, is inflation going down for the right reasons or for the wrong reasons? And right now, the market doesn't care. The market doesn't distinguish anything at all. Why? Well, to spare you the time of reading James McIntosh's article, I can just summarize the whole thing here for you in a couple of seconds. It's because the market is a cocaine addict. What is the cocaine, Maverick? It's the Fed's liquidity. How did we get here, Maverick? The answer is years and years of quantitative easing that distorted everything. So right now, the market doesn't care. All what the market cares about, oh, wait a minute, is the Fed about to be done raising rates? Are they about to bring the cocaine back? Whoop, we're going higher. We don't care why. And in that assumption, a lot of danger and the possibility of an unpleasant surprise. And it all revolves around the syndrome we call the light at the end of the tunnel. More on that in a second, but I don't know if you remember or not, but we have something we call the wall of hope, which has been driven the market higher this year. And basically, it's 3 elements here. China optimism, the optimism that the Fed and other central banks had done with hiking rates, and the AI hype. Well, recently, all 3 were active. Even China, all of a sudden China optimism is back on the table here. Why? Because we got sheeptimism. You see, ahead of the visit by Chinese President Xi Jinping, there was a lot of optimism that perhaps they're going to announce a bunch of deals and multi-billion-dollar deals with U.S. companies. So we have to buy in anticipation of that. And of course, Mr. Xi Jinping is the true ruler of this country. The moment he shows up, of course, all of your beloved companies and CEOs and business leaders and politicians, they're all bowing down, kissing the ring, shining the shoes, and of course, kissing his rear end because he owns them and he knows that. But of course, the visit of the Chinese president was not without any hiccups. The moment he left, President Joe Biden said something that he shouldn't have said. And of course, the babysitter-in-chief of this country, Secretary of State Anthony Blinken, was not pleased at all. Take a look.
Mr. President, after today, would you still refer to President Xi as a dictator? This is a term that you used earlier this year.
Well, look, he is. I mean, he's a dictator in the sense that he is the guy.
So Joey B goes, oh yeah, he's a dictator, Jack. We told you that before. And Blinken is like, oh, here he goes again. I got to clean up this mess later on. And look at him here. He's like, what is he saying now? Is he starting a nuclear war? Then he looks at the other guy, John Kirby, and is like, oh, thank God. No nuclear war this time around. But this is where we are, ladies and gentlemen. Collectively, we have lost our minds. We have this guy as a leader here who could start a nuclear war at any moment, who can wreck the economy at any moment. You never know. But folks, this visit by Xi Jinping, the Asian summit, was not without any fruitful things that we can be thankful about, since we're getting closer to Thanksgiving anyways. For example, the streets of San Francisco, famously filled by homeless, piss and shit all over the place, well, they got cleaned. And California's beloved governor, Kim Jong-un Newsom, says, well, of course we did clean up. We have a visitor. We did not clean it up for years because of you people. We don't care about you, but we care about the visitor. And now, of course, the entirety of the United States is asking Xi Jinping to stop buying the tour to all American cities. Perhaps that's going to clean them up. Maybe Xi Jinping can stop at the border too. Maybe he can solve that problem. But anyways, sheeptimism and China opening optimism and all of that crap went down crashing by the end of the week. Why? Because we got Alibaba. And that stock went down crashing by 10% because apparently the company came out with undesirable earnings. And there goes China optimism. It's over now. So we got two left. Let's take the easy one first. And that is the AI mania. And the AI mania is about to be tested, perhaps the most serious test for the AI mania. What are we talking about? We're talking about NVIDIA's earnings coming out this week. And if NVIDIA disappoints and the bar is way, way too high, if they come out short, then we will see perhaps the official end of the AI mania. We also have this chaos with the OpenAI. So Friday before the close, we got the news that ChatGPT is now firing the poster boy of this whole AI mania, Sam Altman. Goodbye. No explanation. Nothing at all. Nobody knows what the hell happened. And of course, the oligarchy and the banksters, they came out over the weekend and said, we stand with Sam. We want Sam here. This is our guy. He's been working for us. And of course, all of a sudden, OpenAI board is now in discussions to get Sam Altman back as CEO. What the hell is going on here? I think there's an Epstein angle to this whole story. But until they figure it out, this volatility is going to cause a lot of problems in the stock market, specifically in stocks that went way too high, way too fast recently. And combined with a disappointment by NVIDIA, it could again mark the official end of the AI mania. But until then, folks, we have to talk about perhaps the most important element right now, which is the light at the end of the tunnel. The Fed is done. That's the narrative that we got this week. CPI coming down, which means that the Fed is done. And the next step is they're going to cut rates. And this is the Goldilocks scenario. And we're all going to live happily ever after. Inflation has been defeated, yet the economy lives. The miracle is here, folks. Courtesy of St. Jerome Powell. Here's the problem, though. You see, we have gotten before, at least in the year 22, we've gotten weaker CPI readings. And we got the same syndrome. Oh, this is the light at the end of the tunnel. Maybe the Fed, mission accomplished, inflation is going down. Let's jerk off and pump the stock market higher. And then in 22, we got the light at the end of the tunnel was actually an incoming train. And that incoming train was that inflation is not going away. It went back up higher again. This time around, though, in the 23 light at the end of the tunnel, we got better evidence here, folks. At least that's what the market thinks. And that evidence is, it's not just that the CPI is going down. It's also retail sales. What kept inflation higher, that's going down too. For example, this week we got the news that U.S. retail sales fell in October for the first time in 7 months. Now, this is bad economic news, but the market looks at this as, oh, it's good because it's a confirmation that inflation is done. We also got this headline, U.S. weekly jobless claims rise more than expected, and the continuous jobless claims are the highest in 2 years. Bad economic news. But the market loves it. Why? Because they look at this as a confirmation that, look, inflation is now going down, and it's going down for good, which will back off the Fed. And at some point, we're going to resume the flow of the Federal Reserve cocaine back into the economy, back into the market again. We have to get ahead of that and buy right now. But folks, as this headline says, soft landing hopes drove the stock market rally. But investors should not be celebrating yet. Why? Because there is a thin line between the soft landing and the recession. And there's a period when the Fed raises rates aggressively, and for as long as they did, we know what the impact is. There are lags. Raising interest rates hits inflation first, and then little by little, as higher interest rates stick in the economy, they begin to impact consumer spending. And as the consumer gets weaker, the response by corporations in the economy is to lay off employees. We begin to see the unemployment rate rising higher. And that marks the beginning of the recession. Of course, by that time, it's already too late to prepare. The time to prepare is right now. Not like the folks in CNBC who say, yeah, we don't see the recession right now, so let's keep the party rolling. And they said the same thing, by the way, before the GFC. They waited until the crash happened. And then they said, oh, folks, by the way, we are in a recession right now. Hey, investors, you might want to de-risk now. The market is down 50%, so you might want to de-risk right now, not before. Why? Because they play this game every single time. And this goes back to the light at the end of the tunnel syndrome. Be careful what you wish for. That light at the end of the tunnel that you see right now, that's probably not the exit. That could be an incoming train. Wait till you find out that light at the end of the tunnel is Hamas. Wait till Hamas comes out of that light at the end of the tunnel, and that will be the recession. You see, folks, before every crash, the talk about soft landing keeps getting louder and louder and louder every single time. Why? Because there's that thin line between the soft landing and the recession. The light at the end of the tunnel might not be what it appears as right now. It could be something that we don't want to see and we don't want to encounter. Before the GFC, and perhaps the most devastating recession since the Great Depression and one of the most historic stock market crashes. This was the narrative. The IMF, August 6, 2007, soft landing ahead for the U.S. economy. The New York Stern Business School came out with a cover, Soft Landing. That was the cover of the magazine. February 15th, 2007, New York Times, Fed Chairman projects soft landing for U.S. economy. The SBJ, headline, November 26, 2007, National Economy on Approach to Soft Landing. The Dallas Fed, September 26, 2007, U.S. Economy on Track for Soft Landing. Ben Bernanke, Chairman of the Fed, March 28, 2007, No Recession on the Horizon. And of course, the Minister of Propaganda, Janet Yellen, today she says, oh, the U.S. economy is heading into a soft landing. There is no recession. Let's hear what the Ministry of Propaganda said back before the crash of 2008-2009. She was the head of the San Francisco Fed. And in the outlook, the U.S. economy in 2007, listen to this. Janet Yellen says, in summary, I believe that a soft landing is the most likely outcome over the next year or two. And we all know what happened next. Anyhow, Janet Yellen said that, however, I hope my remarks so far make it abundantly clear that there are sizable risks to this forecast and that I'm especially concerned about the upside risks to our inflation forecast. Now, we all know what happened. Inflation did come back when the Fed paused and cut rates, but mostly it was limited in energy. We all remember back in 2008, the prices at the pump. They were insane. But the risk that ultimately crashed the economy was not really the upside risk in inflation. It was the risk of a recession that everybody minimized. And this time around, we know that the inflationary dynamic has stronger footing than 2007. We talked about this in last weekend's video. Deglobalization, AI, climate change, nationalism, the lack of resources, green energy, all of these are inflationary in nature. And we know that defeating inflation is easy, but it requires a recession. The recession is the one that takes care of inflation. The problem is this time around, inflation is too strong that we could have a recession, but we could also have an inflation that sticks above the Fed's target, and it goes to 3% and just sticks there. And then the Fed, of course, will have to hike their inflation target to rescue the economy at that point. But it's going to be a mess. It's going to prop up inflation back higher again. And we'll be in a big stagflation problem for years to come. Anyhow, folks, one step at a time here. Because right now, for example, you got the good professor from Wharton, Jeremy Siegel, who says, oh, the market bottom is here. Oh, we got a soft landing. Same guy back in 2008 said, my forecast for 2008, don't count on a recession, but look for stocks to have a good year. We all know what happened. September 2nd, 2009, the biggest propagandist in economic history, Paul Krugman, he asks, how did economists get it so wrong? Well, the short answer is they listened to propagandists like yourself. That's what happened. But folks, I want you to listen to this. This is from February 14th, 2007. I want you to listen to this carefully. Does it sound pretty much exactly to the same narrative that we have right now or not? Financial Times, February 14th, Valentine, 2007. Fed sees soft landing for economy. Stocks and bonds jumped on Wednesday after Ben Bernanke laid out a fundamentally benign analysis of the U.S. economy in his twice-annual testimony to Congress. The Federal Reserve Chairman painted a picture of recovering growth, moderating inflation, and reduced economic risks that evoked memories of the quote, Goldilocks, end quote, economy of the late 1990s. So-called because it was neither too hot or too cold. Of course, I'm going to show you why the 1990s example is not applicable here. Anyhow, Mr. Bernanke struck a temperate tone on inflation, reiterating that the Fed's view that it was still a bigger risk than growth, but he made no effort to prepare the ground for another interest rate rise. Instead, he dropped a heavy hint that rates might stay on hold at 5.25% for some time, saying the current stance of policy is likely to foster sustainable economic growth and gradual ebbing of core inflation, end quote. The absence of more hawkish language on inflation and interest rates and recognition of the continued risk to growth from housing was greeted with relief by investors who had been troubled by recent talk from some Fed officials. The S&P 500 rose, Treasury bonds also moved higher, with the 10-year yield falling to whatever, similar circumstances as we have right now. The futures market priced in a greater chance of a rate cut this year, while the dollar fell 0.7% against the euro, 0.8% against the sterling, and 0.2% against the yen. Sound familiar or not? Anyhow, Mr. Bernanke said, quote, waning of the temporary factors that boosted inflation in recent years, you know, the transitory thing, it was also said back then. Folks, this is deja vu. For those of us who were not, 6-month-old back then, we all remember what happened. We all see the irony right now. But anyhow, continuing, including pressure from higher oil prices and rising rents, would, quote, probably help foster a continued edging down of core inflation, end quote. But he said the high level of resource utilization remained, quote, an upside risk to continued progress on inflation, end quote. The Fed chairman said that he was following closely signs of distress in the high-risk mortgage market, but said, quote, I do not think at this point it has implications for the aggregate economy, end quote. And of course, we all know how this ended. We're expecting a soft landing, Bernanke said, as the economy collapsed. So we have to go back to what we have right now. Sure, inflation is cooling off. That is an expected result from higher interest rates for as long as they've been higher. But what else is about to go down or probably going down along with inflation? Now understand this, inflation is sticky and it will still be relatively higher. 4% core inflation is double the Fed's target. But the concern right now should be the weakness in consumer spending. Would that lead us to higher unemployment and a recession? One step at a time. This week we got warnings. Home Depot, warning of consumer spending weakness as we see spending on big-ticket items pulling back. We got a warning from Walmart. Stock went down by 8%. We're talking about Walmart here. We're not talking about a penny stock. Why? The company warned that consumers are tightening their belts. They're now spending less. The consumer is getting damaged by higher interest rates and higher inflation for about 2 years now. Target also came up with a warning. The comps were down year on year. And they see consumers pulling back even on groceries. And it's not just the consumer side, you and I, but also the corporate consumer. This week, we got a dire warning from Cisco. Stock went down by more than 10%. Why? Cisco plunges after corporate spending slumps, hurts the forecast. So you see now the impact of this economic weakness. And the excitement about a drop in the CPI is not happening while we see the economy holding. It's happening because the economy is slipping into a recession. What are we talking about? Here are the categories of the CPI, selected categories. You can see that the essentials went higher. The non-essentials went down. So when we look at tobacco, smoking products, that increases as the consumer gets weaker, as we start to see depression and desperation by the population out there. We see more spending on tobacco, smoking, alcohol. So there is no surprise here that we see those categories increasing in the CPI. Motor vehicle insurance, that's a necessity. Utility gas, hospital services, meat, poultry, fish, eggs, food, rents, medical care commodities, dairy, electricity, bakery products. All of these are moving higher. These are necessities, ladies and gentlemen. But the health of the economy is always judged by consumer spending on non-essentials. Travel, leisure, cars, big-ticket items. All of these categories are down. And a reminder, the majority of the jobs created, quote-unquote, created, we know they were not created, they were just added back are in the leisure and hospitality businesses. Well, as the consumer begins to cut back on these categories and understand that the majority of these jobs were gained back at higher wages. In other words, these employers, they cannot really sustain paying these higher wages if consumer spending goes down. In other words, that's going to lead to higher unemployment rapidly. One step at a time, once again, folks. You see the categories in the CPI. Here are the categories for retail sales. Once again, health, groceries, food, non-store, clothing, all essential. Spending is higher month on month. Furniture, miscellaneous stores, autos, sporting goods, building, gasoline, general merchandise, all down. In other words, now the consumer is getting so squeezed that they're spending on essentials, but they're cutting back on non-essentials. And that's dropping inflation down in certain categories. And if this was not enough of a proof for you, here it is. Look at the CPI, Consumer Price Index, and retail sales. CPI is going down because we see retail sales going down. In other words, the evidence is clear. Inflation is going down for the wrong reasons, the recessionary reasons. And that leads us to the unemployment rate and the loss of jobs in this economy, which is coming in a big way, in a shocking way, rapidly. Look at continuous jobless claims that we got this week. We're back to the same levels from 2 years ago at 21, when we were getting out of a recession because of the insane spending, the stimmies. Well, we can't do stimmies anymore this time around with the deficit, inflation, and bond yields. Now, what is the significance of continuing jobless claims going higher? Here it is. Every single time, continuous jobless claims went higher. That was a leading indicator that the unemployment rate in the economy will also move higher. And with that comes a recession. Every single time. To the soft landing crowd, to the Goldilocks crowd, be careful what you wish for here. That light at the end of the tunnel is a massive incoming train. And it's called a recession. Look at what happened, how fast the rise in jobless claims took place in 2008. It came out rapidly, really fast, accelerating, and everything happened in a short amount of time. The pumpers, the government, the perma monkeys, the perma clowns, they were all saying, there's nothing to be worried about here. We have a soft landing. Yeah, Bear Stearns went down, but JP Morgan plugged the hole and the Fed is here. They're cutting rates. What are you worried about? Then came Lehman, and the dominoes began to fall fast. You couldn't even wrap your head around. All of a sudden, the unemployment rate is just shooting up higher. Foreclosures shooting up higher. Car repos shooting up higher. Everything happened really fast. You couldn't even prepare. Either you were prepared before and you endured the downside, and it probably was good for you because you scooped up a bunch of assets at a cheaper price, or you were caught, I don't want to say by surprise because the evidence was clear that we were heading that way, but you got caught with your pants down. And there was a lot of pain. People lost their jobs. People lost their homes, their cars. It took years to rebuild here. And folks, it comes back to this. See, I know what you're going to say, but what about the 1990s example, Maverick? Go to Wikipedia, just for simplification reasons, and type soft landing economics. Here's the most important piece. As it stands, these forecasts have very little scientific value, and there is not one single verifiable instance of soft landing following an economic bubble. Are you listening or not? Once again, there is not a single verifiable instance of a soft landing following an economic bubble. This is enforced by definition, as any potential bubble followed by a soft landing would, in retrospect, not be deemed a bubble. In other words, the 1990s example, there was no bubble. This is why we got a soft landing. In the GFC case, we got a bubble. We got a bubble in inflation, we got a bubble in housing and in lending. This time around, we got the everything bubble. Bonds, stocks, homes, cars, wages, everything. So you cannot say, by definition, you cannot say that we're heading into a soft landing unless you believe that we were not in a bubble. And you cannot say that. You cannot say that looking at what happened since the crash of 2020. The trillions and trillions and trillions of dollars that flooded the economy, they definitely created a bubble. The everything bubble, the mother of all bubbles. And therefore, you cannot say that we're heading into a soft landing. It will not happen. It never happened before. And this time will not be different. Anyhow, folks, let's talk about the market a little bit here and our strategy for this upcoming week, because it's going to be a shortened trading week. We have Thanksgiving coming up. So Thursday, it's going to be off, and then we have a half day on Friday. So that's the bullish element of this week for the stock market, that we have a shortened trading week. We have low volume. The path of least resistance is higher, but we also have a lot of concerns here. Concern number one, we are really elevated here, overextended technically, mechanically. And of course, we have the chaos with OpenAI, and then we have NVIDIA's earnings. So the risk is balanced here. So we need a strategy for this week. But let's rewind here, folks, because unfortunately this channel keep getting accused all the time of being a perma bear and all of that. And look, at this point, I wear the title Perma Bear as a badge of honor. It means I'm not stupid. It means I don't have my head up my ass. But again, we had a strategy. So in this pop, we did not anticipate it, but we played it. And when the chart was here, you can go back to the video. It was a public video. It was not a members video. And you're looking at the SPX here, the S&P 500 daily chart. And we got outside of the Bollinger Bands. And we became really oversold. We said, folks, the risk is for a rebound. Did not anticipate this mania. Anticipated a rebound only. So the strategy was, let's keep long-term puts and short-term calls. Then we got to Wednesday, the FOMC, and things began to look a little different. We put in a strategy, and the strategy was pretty much buying the SPY 420 puts, expiration date next week. This is, of course, November 1st. And buying the TNA, which is the 3 times bullish index for the IWM, 24 calls, also expiration date next week. Of course, this is back November 1st. We also said, look, folks, you got to close the puts in the Qs on Apple, Nvidia. All of these charts have passed technical indicators, have passed certain moving averages. And by default, the quant funds, the algos, they buy if certain charts pass the moving averages. So we were clear here, folks. And the strategy paid off. We made 700% worth of gains from those TNA calls. Then we got to this point that I'm pointing out right now here in the chart, and we were anticipating that we're going to see a pullback. And the pullback will be an opportunity to buy at a better price and perhaps restructure some trades that are not working. We had some SPY puts at that point to anticipate that. Unfortunately, the only pullback that we got was a lousy pullback. I wouldn't even say there was a pullback. It was just a tiny drop. And then came by the end of the week, that Friday, as I'm pointing out right now, we got a reversal. We popped higher again and erased the entirety of that drop candle. And at that point, November 10th, we put in a strategy that we need 2 upside exposures and 1 downside exposure. And I gave you a few options here. Either we go with the SPXL, this is the 3 times bullish index for the SPY, 85-90 call spread, expiration date November 17th. You can also go with the IWM, either the 170-175 call spread or the IWM 173-178 call spread, same expiration date November 17th, which was last Friday. And the down exposure that we got is Microsoft 365-360 put spreads, expiration date December 1st. So this was the strategy. And we know that the upside exposure paid off. SPXL paid off. IWM paid off. Big time. Microsoft began to work out on Friday. So we'll see what happens. And of course, midweek, we gave another strategy, which is, look, we have the chase trade, which is the positioning, the big caps, the Mag 7, ex-Tesla. And then we have the momentum trade of the Ozempic mania. On the other hand, we have the catch-up trade, which is if the dollar goes down, then gold, silver, gold miners, metals, steel, fertilizers, copper, energy will do pretty good. Tesla was the only laggard of the Mag 7. So this was part of the catch-up trade. And then we have yields going down. That's going to be good for the XBI, Biotech, XLU Utilities, XLP Staples, IYR Real Estate, IWM Small Caps, KRE Regional Banks, XHB Home Builders. And we said go with the catch-up trade and avoid the chase trade. A lot of these bets played off, whether it's the GDX Gold Miners or Nutrin, Mosaic, Tesla, XBI, Biotech, all of them did pretty good this week. And for now, so long as we see the dollar and yields going down, in this upcoming week, we want to stick with these trades right here. Tesla, we'll talk about it in the charts analysis. Maybe it has a little more room to go higher here, but we'll talk about that in the charts. But this week, I want you to look at the dollar and yields. If they keep going down and stick lower, you want to stick with the upside exposure in the catch-up trade. Avoid the chase trade entirely. We actually want to pick some downside exposure from the chase trade. So what do we do here? Looking at the chart, we know what the risk is. The SPX or the Qs or any chart you look at, really overbought at the risk of any catalyst that comes out of the blue and dropping the chart big in a correction for this massive upside that we've seen recently, which was based on the mechanics, short covering, algos, quant funds, capitulations by some of the managers, capitulation by a certain slice of the retail investors. Not all of them though. The majority of retail is staying out of this right now. So we need some downside exposure here in case we drop down. Here's an important thing for you to understand, folks, because a lot of you unfortunately make the same mistake over and over again. You see a chart down big or up big, and then you take the opposite side. But you have to be careful. I'll give you an example for charts that went way too high. In this case, I'm using Qualcomm. QCOM daily chart. You see the RSI way overbought. The chart is breaking outside of the boundaries of any technicals here. You look at this chart and say, Maverick, this is going to drop big. I gotta buy puts here. Here's the problem though. You gotta understand the concept of implied volatility. You see, when things move up big or down big, forget about the VIX. There is something called implied volatility for the individual stock, and usually it prices in the implied volatility, duh. So when something goes way up, understand that the pricing of options is also pricing in a big drop. And your job is to get options that are priced cheaply, that are easier to flip into profits, not to overpay for expensive options. Because what happens is, when the opposite move takes place, the implied volatility goes down. With the reduction of the implied volatility, despite the fact that the trade is going your way, option premiums drop down. So you end up overpaying for the puts. If you buy them in Qualcomm right now, stock goes down. If it doesn't go down enough, in a big way, 9-10%, you end up holding the bag. Here's the illustration for you. If we just pick Qualcomm puts December 1st, we don't want to pick 24th, by the way. 24th, if you do any options on 24th, you're probably going to lose money because it's a shortened trading week. But if we go to December 1st here, and we pick in the money options, the 130 puts in the case of Qualcomm, because the stock traded at 129.5 by Friday's closing. Notice that by the expiration date, if the stock goes down by about 1%, you'd lose 32% of the value of your options. In other words, we know that the pricing of these premiums is not favorable to us. The implied volatility right now at 27.5, that's too high for Qualcomm. So whether you're buying calls or puts, they're really expensive. So you have to shop around here, folks. If we look at Apple, for example, and this is the idea that I floated on Friday, it's a similar chart with Qualcomm, and if they all pull back, they'll pull back together. After a rally like this, they're all going to go down together. The beauty with Apple, though, the RSI is elevated, it is pushing the boundaries of technicals, we get all of that. So suppose it goes down. Why is Apple a better case than Qualcomm? You look at the options, you pick the nearest in-the-money put options, 190, same expiration date, December 1st. Now, suppose Apple goes down by about 2% by the expiration date. Your gains are going to be 73% if you pick the 190 puts. So we know that the pricing right here is a lot better than Qualcomm's. The implied volatility here is 16%. Now you might say, but Maverick, Qualcomm moves in a more volatile way than Apple. I would disagree. I would think at this setup right now in the charts, they're all going to move down together. And the move down will probably going to be led by the big caps as money comes out. Profit taking, de-risking, that kind of stuff. You can spice up the trade a little bit by opening a spread. And this is the one that we did on Friday, the 190 puts. And we sold the 185. That way, Apple goes down by 1.5% by the expiration date, December 1st. The gains will be 100%, a double. Now, you can expand the range a little more if you'd like, and you pick the 190 puts, sell the 180 puts, same expiration date, and if Apple closed down by about, let's say 2%, you'll be at gains of about 99%. So the pricing here is a lot better than the pricing that we see in other stocks. And you only need one here, folks. You don't need to go in a shopping spree, Black Friday, buying puts on every stock. If equities go down because of NVIDIA or OpenAI or just seasonality or de-risking ahead of the holiday, or because the stocks, the charts went way too high too fast and now we have overbought conditions, doesn't matter what the reason is. They're all going to go down together. Not the laggards though. So this is why we're going to keep upside exposure in the laggards, the catch-up trade. Not all of them, but selected few. And on the downside, we're not going to pick a lot. I think that the Apple trade alone is sufficient. You go down 1.5%, 2%, and the value for put options double. So this is the strategy right now. If we continue to see the dollar and yields going down, we'd like to stick with the catch-up trade. Once they become overbought, then we get rid of them. Likewise, we need one downside exposure here, and at least the way I see it, Apple's options are priced pretty good, so we're just going to stick with those. And folks, the week is going to be really important. NVIDIA, of course, is the most important name. Go look at those options. See if the pricing is good or not. The pricing is out of whack. You're going to need a 20% move to make your money back buying these options. We'll do a play on it anyways. But the point being here is about 14% of the value of the S&P 500 are just two stocks, Apple and Microsoft. And these two happen to be the best performers since the month of November began. And therefore, there's no surprise that we see an impulsive rally in the S&P. But if they go down, their rating will also take the S&P down with them. And this is the problem that we have in the structure of the market right now. It is really dependent on a handful of stocks. And I think if they go down because they're technically overbought or because we have a souring of the AI mania because of NVIDIA, that we will see a sizable counter reaction to the action that we got since the beginning of November. remember, every action has a reaction. A big impulsive rally will also meet a big drop, a correction, and that's what we're aiming for now. We'll talk about this and a lot more in the charts analysis, but let's expand the conversation a little more here and talk about the market info. We begin with the closing of the indices last Friday, and here we go. The diamonds closing flattish pretty much, be it positive 1.81 points or a gain of 0.01%. Nasdaq, same story here, everything is flattish. The market maker didn't want to move us up or down because we had a large amount of out of the money calls, out of the money puts, and of course the market maker figured out that if I keep the price flattish, that's going to achieve maximum pain for the majority of these out of the money options, be it calls or puts. So we see the Nasdaq flattish, be it up slightly here by 11.81 points or a gain of 0.08%. Spider up by 5.78% or a gain of 0.13%. Russell 2000, it dropped big on Thursday, so the max pain was already achieved a day before expiration. This is why the Russell was able to recover on Friday, because max pain was achieved a day before. So we see the Russell 2000 up by 2.41 points or a gain of 1.37%. The sectors on Friday, the gains were led by a rebound in energy, but be careful here, this is just a dead cat bounce for now because we got a lot of bad economic data. We got an oversold rebound in energy stocks Friday. Then we have cyclicals at number 2 and financials at number 3. The laggards led by comm services, defensives, real estate, and technology. The week all in all, green across the board, led by real estate, that's yield sensitive. Yields go down, rates do pretty good. Materials at number 2, that's dollar sensitive. Dollar goes down, materials do pretty good. Utilities at number 3. Utilities, yield sensitive. Yields go down, utilities do pretty good. So if we see a rebound in the dollar or yields this week, then these sectors will probably pull back a little bit and we see profit taking from these sectors. So keep that in mind. What about the breadth on Friday? Pretty good in the NYSE, 74% advancing versus 24% declining. The Nasdaq, 66% advancing versus 31% declining. So notice that the indices were flattish, but the breadth was pretty good. Why? The majority of declines came from the big caps, but the rest of the market did pretty good. Yields, dollar, they're both down. We see the majority of the market, the value sector, the small caps doing a lot better. On to commodities. This is the closing on Friday. We saw the dollar going down, euro, yen, Kiwi, Australian dollar, all going higher. And the result of that is energy goes up. Although I disagree that the relation between the dollar and energy right now is not really correlated. I think that the rebound in energy on Friday, big rebound, 4% apiece for the WTI and Brent, but that is an oversold rebound for now. Likewise, the gasoline RBOB, with a rebound worth about 4%. Heating oil was flattish, be it positive by about half a percentage point, and natural gas was the loser on Friday, down about 3.25%. When we look at softs, once again, coffee continues to go down a little bit, softening here, profit taking, adjustment from higher levels, so it's down about 2.5%. But boy, the rally in OJ is relentless, up yet again about 2.5% on Friday. Likewise, the prices of cocoa continue to surge higher, with yet another gain worth about 2% on Friday. When we look at metals, the defensive metals, gold and silver, were down. What is the reasoning behind that, even though the dollar was down? Perhaps we're seeing some profit taking here from the hedging. Gold and silver have been going higher because of geopolitical hedging, and we see some of that being taken out this Friday. And perhaps some of this money is chasing the cyclical metals here. When the dollar goes down, we see cyclical metals doing pretty good, so we see platinum, copper, palladium leading the pack here, although you got to be careful. If the dollar is dropping down because of economic weakness, then the rally in copper, platinum, palladium probably not going to last for too long. Keep that in mind. When we look at the performances all in all for the week, we see that OJ, once again at number 1 with gains worth about 12.5%. Palladium, platinum, these are the cyclical metals, all doing pretty good. Silver was a winner, so it doesn't matter whether you bought the defensive or the risk-on metals. They all did pretty good this week because the dollar went down big. The laggards, led by VIX futures, of course, we saw a lot of hedging being taken out of the table, the puts being taken out because if you bought them before the CPI, hedging for the CPI, you don't need them anymore. So those were taken out. We see the VIX down. Wheat futures down about 4%. Natural gas, the loser in energy, down about a little over 2.25%. But of course, the rally that we got in energy in the WTI and Brent rescued crude here. So we see them both going down by about 1% for the week. But boy, had they closed negative on Friday, they would have been down for the week big. But that rebound on Friday was a rescue for crude. Moving on to the options market, the big casino, what do we see here? Obviously, we have OPEX, so the volume will be up across the board. But believe it or not, for an OPEX, as important as it was, the volume all in all was down, which again is a sign that the retail mom and pop they're not participating here. Otherwise, we would have seen the volume up, we would have seen lots of calls being bought, but we're not seeing that. And I see that as concerning for the sustainability of the rally. Regardless, the souffle Tesla, the volume was up big this Friday. 3.6 million contracts traded, about 52% of those were calls. So we see a little more optimism here in Tesla. Likewise, Nvidia, the report's coming out this week, so we see the volume of options going higher a little bit. And again, they're buying a lot of calls here. 64% of the volume was calls. I would caution you, though, that if Nvidia doesn't pop by, let's say, 12% plus, I think it's going to be really hard for you to flip these calls for any money because the pricing is really awful here. And of course, Apple coming out number 3. We saw about 55% of the spread here for calls versus puts, but notice the IV rank. In Apple, the IV rank is 0, meaning this is the cheapest Apple options been in a year. And this is why, if you want to bet one way or the other, go with Apple here. Of course, since we know that the risk is to the downside, after a massive rally like we've seen the last couple of weeks, we choose to go with the put side, and we chose Apple because the IV rank is really low, so we know that the premiums are priced in pretty good. Let's do some of the unusual activities that took place in the options market this Friday, and we begin with the ticker CVNA Carvana. Now, we got the news that Amazon is going to sell new cars from Hyundai via the Prime service, so what do you need Carvana for? At least this is the assumption, so somebody's making a big bet here against Carvana. They bought the 25 puts for the expiration date, February 16th. Expectations, Carvana will go down and lose more than 22% of its value by then. Paid about $2.90 a piece to enter this trade, all in all spending about $3.7 million. And then we have the RKK for Tesla witch Cathie Wood. Now, honestly, if we're talking about small caps going higher, maybe RKK is a proxy play for that, but I'd rather be with the IWM, not RKK, because Mama Kathy is gambling as she's shuffling plays from one stock to the other. You can't really follow her plays right now. I would actually take the opposite side of this trade, but if you're interested here, it's the 47 calls, expiration date December 29th. Expectations, Mama Kathy Wood will go higher by about 7.5% by then. Paid about 88 cents a piece to enter. Trade, all in all, spending about $900,000. And then we have a trade here for the XLF, which I thought it was really brilliant here. We talked about the hedges shorting the XLF and the KRE. They're shorting all financials, really. They see some sort of a systemic risk coming. And you can look at the trade above for Charles Schwab. You can pick that one if you think Schwab is going down. But I like the XLF spread here because the cost is really low. You're going to have to pay the ask price, though, because the spreads are wide. And for the one you sell, you're going to have to receive the bid. So just keep that in mind. The spreads here are not really pretty good for the XLF. But the trader here bought the 33 puts and they sold the 30 puts for the expiration date February 16th, with expectations that the XLF will go down and lose more than 6% of its value by then, but not more than 14%. Paid about 46 cents a piece to enter the 33 puts, received about 9 cents a piece from selling the 30 bucks puts. All in all, spending about 37 bucks for this spread right here, which brought the total all the way to about $160,000. On to the heat map on Friday. What do we see here? A little bit of a pullback in the big caps. So we saw Microsoft negative, we saw Google negative, Nvidia down a little bit, perhaps in the heels of the awful reaction to earnings from AMAT. You can see that box right there, the anomaly in technology, down about 4% on Friday. Apple was flattish, Meta was flattish, Tesla was flattish. So we saw the indices flattish, although Amazon was the winner here, up a little over 1.5%. But the majority of the action was in other corners of the stock market. For example, we saw financials going up with yields going down. We see some buying of financials here. I don't think that's sustainable at all. We see some buying of energy as a rebound, short covering. They dropped big. Here comes Friday. You have no idea what's going to happen in the geopolitics in the war in the Middle East over the weekend. So we see short covering in energy. And this is why I say be careful. Energy has turned bearish right now. Why? Because we got recession data. We'll look at the charts in a minute. We'll show you when they become bullish again. But for now, be careful of following some of these rebounds. Besides that, folks, it was a mixed reaction here across the board. Certain names, we've seen them going down. Winners for the week, we see some profit taken by the end, such as Nike was down about 1.5%, Starbucks down 1.5%, so we see some profit taking there, and some short covering as we talked about in energy. So that's the dynamic on Friday. It was flattish, it was boring. The market maker wanted to close flattish to achieve maximum pain. Yet if we contrast this heat map with the weekly heat map, the picture becomes clearer. So we know that we're a mid-earnings season. And we'll see that some stocks go up big or go down because of earnings. Case in point, you see the downside reactions easier to spot in an all-in-all green week. So we see Alibaba down, we see Walmart down by about 6.5%, we see Cisco down by about 10%. But we know that the dynamic for the week was the dollar goes down. So what is dollar sensitive here? You go right away from metals. So you see FCX, Freeport McMoran doing pretty good. Gold miners, NEM was pretty good. A lot of you made a lot of money buying calls in NEM. The fertilizers, Mosaic, Nutrien was a good trade this week. And of course, when the dollar goes down, we see the multinationals in industrials doing pretty good, such as Caterpillar, Boeing, GE, UPS, all doing pretty good. And of course, we have seen yields going down. When yields go down, what does good? You have financials doing pretty good. Some of the software, risk on, high valuation in chips and software did pretty good. It was also a green week for the home builders, DHI, DR Horton, Lennar, the cyclical side of the economy, Home Depot, retails, although some of them blew up, but all in all, when yields go down, high debt companies such as retail and any yield-sensitive sector will react positively. Another corner that did pretty good is medical devices. And there was a lot of talk that medical devices are really cheap right now. And they went down for no good reason. They went down because there was this assumption that Ozempic was somehow make medical devices obsolete, which is absolutely ridiculous here. So we see nice rebounds in Abbott Laboratory, in MDT Medtronic. I think that's a really good name. We'll wait for earnings, of course. But you look at BSX, Boston Scientific also did pretty good. Edwards, EW did pretty good. So we see a rebound here in diagnostics and medical devices. I think this rebound has more juice to it here. Anyhow, when we contrast this heat map with the weekly heat map for the ETFs, what do we see here? A sea of green. Right away, we talked about the dollar being down. We talked about, if you look at the TLT here, TLT up means yields down. That's a positive dynamic for pretty much every stock out there. But we see the yield-sensitive names performing a lot better. IWM was the leader, small caps. You look at XBI Biotech, you look at the KRE regional banks, you look at the XLU, you look at the IYR, you look at the XHB, ITB. All of these are yield sensitive, and they led the market rally this week. Dollar sensitive, GDX, gold miners, GLD, IAU, all of these are gold ETFs, and then you got SLV silver, massive gains, worth about 7% for the week. That's because the dollar went down. When the dollar goes down, it's also good for international markets. So we see developed markets doing pretty good. EFA, VEA, emerging markets, EEM. European equities do pretty good when the dollar goes down. So we see the VGK, massive gains for the week. Chinese equities also do pretty good, but that earnings report from Alibaba really dented these earnings for the FXI. And of course, when the dollar goes down, it's good for energy. So we see the XLE, XOP all positive for the week. But because of the recession data, we saw that these gains attained. And now, since we have the dynamic of the dollar going down and yields going down, this is no surprise to anyone right now. And I would say that the risk is for these to rebound next week, oversold rebounds. What will the dynamic be? Question now becomes, do we just keep the algos on autopilot and they keep buying because we have a shortened trading week? In that case, we go back to the same dynamic of the large cap growth, the chip names leading the market higher. If we have de-risking because of NVIDIA, because of OpenAI, or because of the technicals and the psychology, then we're probably going to see an inclusive sell-off here, where the map is going to be mostly red. And I would say that NVIDIA's earnings will have a sizable impact in the outcome of the market this week. If NVIDIA delivers, then we will see the usual. The algos, the autopilot, buying the same stuff all over again. If NVIDIA disappoints, then it's going to lead a lot of de-risking, profit-taking, hedging, and we will see perhaps an oversized reaction to the downside. So NVIDIA is the key here, folks. Anyhow, let's move on and do some charts and then wrap it up. What do we see here in the SPY and hourly chart? The answer is absolutely nothing. We got support, 448.77. We got resistance at 451.37. Nothing happened here. But psychologically, how do we read the chart? The chart right now is consolidating. It's running out of fuel. We know that. How do we know that? We know that the shorts are pretty much done covering. They did a little bit of shorting before the CPI. That went the other way. So now the shorts are done. They covered. They're out of the picture. Quant funds, they ran out of moving averages to buy based upon. Market maker, they're done. OPEX was last Friday. It's over now. So the mechanical element is being reduced here. Who's else? The money managers, they're already chased. They bought Apple. They bought Microsoft. They bought NVIDIA. They capitulated and they bought. So who's else here? Who's left here? The answer is the retail mom and pops. So the chart right now is just consolidating, saying, hey, retail, do you want to jump in here so we can pop for a little bit, then crash it down on your head, or what? Come on, hop in. And of course, the retail mom and pops are saying, no, I'm not going to hop in here. I'd like to see a better price. So it's a tug of war right now. The chart is inviting new buyers. If the buyers don't show up, then what's going to happen? The sellers are going to show up. And the sellers right now are waiting for a reason. Could the OpenAI fiasco be a reason? Could NVIDIA be a reason? Sure. Could just the technicals be a reason if there are no buyers to show up here? That's the risk, and this is what the chart is saying right now. It's waiting for more feedback. It is inviting the buyers on the sidelines. If they don't show up, then the sellers are gonna. And if the sellers show up, then we have a gap below. That we have few gaps, not just one. We have a lot of gaps here to fill. So let's zoom out to a daily chart and see what's going on here. We know that this is a zone where we stopped before repeatedly. So we know that we have a lot of resistance here. And we're running out of gas. The buyers, they're already in. Everybody bought here besides the retail mom and pops. We still have one gap above to fill. So if we want to go higher, theoretically, that could be possible to close the gap above. But again, I would say the psychology matters more here, plus the fundamentals from NVIDIA. And that combination of the psychology plus NVIDIA will dictate whether this chart goes up to fill the gap above or goes down to fill the gap below. How do we know? Closing above 451.37 will probably lead us to close the gap above. On the other hand, closing below 448.77 will probably lead us to close the gap below. If we look at the E-mini futures daily chart, what do we see here? We have consolidation within range. Let's say 4,500 support, and then we have 45, 44.75 as resistance. Technically, this is a bull flag pattern. So right now, the chart is waiting for buyers. Buyers don't show up, the sellers are gonna. And the sellers will probably take us down to 44.72 as target number one. And folks, we know that this zone right here at around 45, 44.75, this is a really sticky point of resistance. It's been that way repeatedly before, so it would not be a surprise to me if we pull back from this point here. Then what about the SPX, the cash index weekly chart? What do we see here? A reminder, when we got outside of the Bollinger Bands, you can go back 3 weeks ago. We said, folks, the risk is for a rebound. Well, we got a rebound and then some. And now we're above the 20 weeks moving average. Is that bullish or bearish? The answer is, it is bullish. But does that mean that we're going back to the highs and make all-time highs? One step at a time. Why do we say that? Because we have a channel here. We broke below, and that threw off a lot of bears, by the way. They thought, okay, this is the beginning of a big slide down. But being outside of the Bollinger Bands on the weekly chart is always a warning sign that the opposite move could happen. Well, we're not necessarily at the top of the Bollinger Bands here, but we're above the channel once again. And the most immediate risk right now is the symmetry. Since we got a false break to the downside, is the break that we have here to the upside above the channel a false break too? Well, we know. There's only one way to know. If NVIDIA bombs, and we see the SPX going down, losing the 20 weeks moving average, then understand that this was a false break, and down we go from here. How about the Qs? NASDAQ, hourly chart, what do we see here? Again, consolidation inviting the buyers. The chart is saying, hey, the water is warm here. Come on, retail. How long will you watch this and wait for a pullback? We're not going to have a pullback here. Come on. Capitulate, please. We're at 388. That's the prior high from July. You want to see the chart above 388 and then you hop in? Is that what you're waiting for? On the other hand, folks, if the buyers keep saying, nope, we're not showing up, then the sellers will probably show up. Why? The sellers, meaning the holders, right now have a lot to lose. On one hand, you don't want to be too greedy. You have the technicals really overbought here. Number two, you have the OpenAI fiasco. Number three, you have NVIDIA's earnings. So we have a lot of risk here to the downside. And this game of poker, who's going to capitulate first? Well, I think the buyers are not gonna. The retail mom and pops, they did not like it at 367. Did not like it at 357. Are they going to like it now? I think it's a mistake. I think we should not capitulate here as retail mom and pops, and the sellers will capitulate and they will give us better prices. Now, of course, a lot of you would say, hey, Maverick, what about the crash? What about 87 and all of that? One step at a time. We know what the dynamics are. We know the train that's going to hit the market here. But in the meantime, in the day-to-day activities, we have mechanical elements, we have technical elements. So for traders, you can't really trade based on a crash or an explosion higher. You can't do that. You got to take the market one step at a time as a trader. As a long-term investor or a long-term short, then you can do these moves. But as traders using options one step at a time here, folks, what we have right now is a mechanical rally that is running out of gas, as you can see. We're consolidating below 388. We know that we're overbought. We know that we have a lot of risk here. And like I said, it's psychology. Are we going to close the gap below or past 388? Once again, the key is NVIDIA. NVIDIA delivers, we're above 388. NVIDIA bombs, we're going to go down, closing gaps, perhaps revisit the 20 days moving average, which is, by the way, the mean of any chart. So when we talk about the reversion to the mean, that's what it means. Going back to the 20 days moving average or consolidating to allow the 20 days moving average to catch up with the chart. So again, the risk right here is predominantly to the downside. And folks, we have not seen a real correction here in this pop. We have not seen a real pullback here. We got one, a tiny one, but with no confirmation of a reversal at all, because it never really took the lows of the previous candle, as you can see right here. Got a rejection candle, but did not get a confirmation candle. Had it closed below the lows of that last green candle, we would have gotten a reversal and a pullback. Can we get one right here? Could we form the island reversal, which is one of the strongest tops you can see in the market here? This is why I say that this week will be pivotal, despite the fact that it is a shortened trading week. Let's look at the Q's weekly chart. What do we see here? Of course, we talked about the risk, folks. Once you get outside of the Bollinger Bands in the weekly chart, up or down, you're facing a lot of risk that the opposite move will take place. So 3 weeks ago, the risk was for a rebound. We got a rebound and then some. What is the risk right now? The risk here right now is we're pushing the upper boundaries of the Bollinger Bands. And we're reaching the same highs from July. And the hour side, if we look at the hour side right here, the rebound was on weaker volume. In other words, all in all, it's a weak rebound. It's happening because handful of names and really weak volume. We've seen this phenomenon before if you look at the RSI here, and that was back in March of 22. And of course, I made a mistake here in highlighting the summer rally of 22. It should be one step behind at the March rally, the bear market rebound that we got at that time. Of course, the difference right now between this and then is that we're above the 20 weeks moving average. But the point being here is any rebounds that achieve higher highs or the same highs on weaker RSI are always suspect of pulling back quickly here. And likewise, in the weekly chart, if we use the contracting channel that we talked about, we got a false break to the downside. Question now becomes, do we have a false break to the upside? Look at the MACD indicator. We have no confirmation yet that the bullish breakout is for real. NVIDIA bombs, we flush down this week or the week after, and we go back within the channel, the contracting channel, then you'll know it was a false break. And that is a real possibility right now. So we need some downside exposure, and this is why I suggested Apple as the one. When we look at the NQs, the NASDAQ futures, daily chart, what do we see here? Consolidating in a bull flag pattern for now. And the resistance in or around, let's say 16,000, which is the prior highs from July. Can we see a double top phenomenon here, or will we pass? The key is NVIDIA. I would say just look at the symmetry here. We got a topping candle back in July. Did we get a topping candle this time around this week? And down we go from here. That is a real possibility too. So you need some downside hedging right now. As far as the upside, like I said, if NVIDIA is a pass, and we see all of these charts passing the July highs, then understand that the dollar and yields will continue to go down. And you have a lot of ground to make in the catch-up trade. So you're not going to miss out a lot here, folks. But the real risk here, if this pulls back in a big way, and this is why downside risk, even a shortened trading week, is really, really important right now. IWM, small caps, daily chart. What do we see here? Let's start with the bullish outlook first. Bullish outlook says that we have a rising RSI, so this is a sign of strength in the rally. We also have the possibility of a higher low. So if we go back to the gap again, as I'm highlighting right here, then we're probably going to make a higher high. But make no mistake, that candle, that reversal candle, shooting star, morning star, doesn't matter what you call it. It's a topping candle. Close the gap, and then we did a reversal candle. If it sticks, and we don't go back to the gap, then we will likely break 175.63 as support. Once we do that, the risk to the downside becomes real. So the bearish outlook says, if we zoom out to a weekly chart of the IWM, we got outside of the Bollinger Bands, the lower Bollinger Bands this time around, and the risk is always that we will see the opposite reaction, a rebound. Cool. We got a rebound. We got to the 20 weeks moving average. Is that it? Are we done here? And from this point, we go down again. I would say the key to that is if we see a rebound in the 10-year yield. Then we will see the small caps index going down again. And the 20 weeks moving average, probably the target of the rebound. How about the Dixie, the dollar index? What do we see here in the daily chart? Again, we played an inverse ABC pattern. We talked about that. Rejection at the 20 days moving average, and down we went. Now we're forming a bear flag pattern that is playing out. We do have support in or around 103.458 basis points. Now, understand that the dollar could do the drop all the way down to the support line, and then the RSI becomes really, really overbought. And at that point, I would say that the risk is for a big rebound on the dollar. which will push down gold, silver, copper, fertilizers. Any dollar sensitive will go down. But the risk is for a rebound either way at this point, and the reason is we're outside of the lower Bollinger Bands. So we're getting oversold in the dollar. We have a rebound coming. Question becomes, is it going to happen right now, or is it going to happen after we go down a little more? Become really oversold in the hour side, then rebound. Why is this important? A lot of you are following the dollar trade. A lot of you are long copper, gold, silver, fertilizers, steel. When you see the dollar really oversold, if it drops again, you probably want to book profits in those trades. Wait for the dollar to fix some of the oversold conditions, and if it goes down again, then we hop in the same dollar-sensitive trades. Speaking of, the old man is the king of dollar sensitive here. On the daily chart, we're above 1962.58. We're above the 20 days moving average. All of these are bullish. And of course, the upside risk is we do have a series of higher lows, and the assumption is we have a higher high coming. Here's the downside risk though, that we fail right now and we form a lower high and we lose the 20 days moving average. Now, I would think that the reason behind that will be a rebound in the dollar. Yet when we look at the weekly chart for gold, what do we see here? The opportunity, of course, came when we went down. In the weekly chart outside of the lower Bollinger Bands came the rebound. It pushed all the way to the upper Bollinger Bands, then came down, retesting the 20 weeks moving average. That test was okay. We got a rebound. So even if we pull back here without losing the 20 weeks moving average, the assumption is gold will make an ABC pattern and rally higher. SLV silver, what is the risk here? The risk is that we're outside of the upper Bollinger Bands, so the risk for SLV to pull back is higher than GLD or GDX to pull back. SLV way outperformed gold this week, so the risk for it to pull back is higher than gold. Doesn't mean that it's bad, by the way. The pullback will be okay so long as the dollar going down. Daily chart of UK oil, aka Brent oil, what do we see here? We talked about once you break 85, you have an inverse ABC pattern. We got that, but we went all the way down to the lower Bollinger Bands. Once we get there, the risk for a rebound becomes real. We got a nice rebound on Friday, but it doesn't reverse the downside. Had it closed above the breakdown candle, we would have said, okay, we have a reversal here, and more gains to come in oil. But we can't say that right now. So if we look at the XLE, this is a daily chart for oil stocks, the ETF. What do we see here? We got a pop on Friday, but short of closing above the 20 days moving average. So we have no confirmation here. We have good signs that oil is oversold, but we need to see more confirmations here. With the recession news that we got this week, you need all kind of confirmation before you buy energy again. If we look at Valero, VLO, refiners, which is the sector of energy that is holding pretty good right now. If you look at the weekly chart, of course, when you look at anomalies above or outside of the lower Bollinger Bands, you get the opposite reaction. We're not close to either right now, but we are below the 20 weeks moving average. Maybe consolidating in a bullish wedge. And if we break above and close above the 20 weeks moving average, then refiners will be a better comeback play in energy than big oil and the rest. Just keep that in mind. But the downside risk right now is the predominant risk in all energy, including refiners. If we look at the 10-year yield daily chart, what do we see here? Obviously, we're broken below all of the important support. We have the last one here at 4.352 basis points. But was the candle on Friday's closing a beginning of a reversal candle? I can make that case. And if we have a rebound this week, we'll probably see equities pulling back. But on the weekly chart, what do we see here? We see declining RSI. We see the MACD now giving us confirmation for bearish momentum. In other words, the risk of going back to 5% is unlikely right now. It's going to require an extraordinary event. So the risk to the downside is highly likely for the 10-year yield right now. The question now becomes, before you get too excited and say, okay, 10-year goes down, pretty good for the equities market, you gotta be careful that it doesn't go down rapidly and big, because if it does that, it's gonna do it for the wrong reasons, meaning recessionary reasons. If that is the case, say goodbye for the soft landing and we see the recession theme in which equities go down along with the dollar and bond yields. So when we look at the XHB, for example, daily chart, it has been trending higher based on the algorithmic reaction alone. Yields go down, al goes by. But was there any thinking process here that yields are going down because of weaker economic data? Then home builders will do bad. I mean, think about home builders. They've been building and buying these materials to build these homes under inflationary prices. Now when comes the time to sell these homes, the consumer is becoming weaker and they have to reduce their prices to sell these homes, which means they're going to have to eat a loss. Their margins will go down. The story of margin expansion in the home builders is gone. It's over. So right now, the market is not really thinking why we're going up. It's gonna. And it could be the algorithmic reaction of just a rebound in the 10-year that pulls the XHB down. And in that case, it will be a minimal pullback. Maybe it gets us down to, let's say, 78.29. But we might see a major flush down here, all the way back to the 20 days moving average. If we see more and more recession news, if the market finally gets the grip that, watch out, yields are going down, dollar is going down, which in the past was good for equities, but now we're going down for the wrong reasons, then we see the XHP flushing down big. And of course, you have to be selective here because the XHP includes Home Depot and Williams-Sonoma. All of these companies have different dynamics, so I'd like to be in the pure home builders here. So when I look at Lennar, for example, LEN, look at the chart. Every time we got here outside of the upper Bollinger Bands, it did not last. It was preceded by a big pullback. Our size really overbought. I see the risk here for the home builders to pull back. So maybe picking on the pure home builders, Lennar, DR Horton, is a lot better than betting on the XHP. But of course, you have to shop for options, look at the implied volatility, and pick the most attractive premiums here. Because if they go down, they'll go down together. What about the VIX 4 hours chart? What do we see here? We talked about the bear flag consolidation at around 14.13. It's been holding and holding and holding until Friday. Friday, we have seen some puts being closed, so the VIX went down. But despite the market rally, the VIX is hanging in there. As if the VIX says, look, the market may be running out of gas. Me, the VIX, I'm running out of sellers here. Of course, the VIX is not traded from buying and selling perspective. It's traded based on the feedback of buying puts on the SPY. In other words, the VIX is saying, folks, anybody who wanted to close their puts, they already did so. They're done. The shorts are done covering. So I'm ready to pop here. I'm just waiting for a catalyst. And could that catalyst be NVIDIA? Something to keep in mind. On the weekly chart of the VIX, it is easier to spot tops in the VIX. Once they get outside of the Bollinger Bands on the weekly chart, probably that's going to stop it. But it's not easy to pick the point from which the VIX pops, which means that a pop in the VIX could happen at any point. And that's the trick here where folks say, oh, the RSI is showing one look, or the VIX needs to go down by a little more. You never know from what point the VIX will pop. Just keep that in mind. Apple, Big Kahuna, hourly chart. What do we see here? Maybe you want to squint your eyes a little bit here because we have different things to look at. We have the gap that we closed above, and then we have a descending line of resistance here with lower highs, and that's holding for now. In other words, a break below 188.57 will be confirmation that Apple topped here in this big rebound that we've seen since the month began. And down we go. And if we go down, we have a few gaps to fill here, but most importantly, if we zoom out of the chart here, look at the daily chart, what do we see? You can see the importance of 188.57. We break that, confirmation that we're going down. How far down can we go? We don't know. But the assumption is after a major move like this, with no corrections at all, that we will see a sizable reaction to the downside, worthy of complementing the move to the upside. And of course, we know that the reversion to the mean requires us to go down to the 20 days moving average. Doesn't mean that Apple has to flush down all the way to the 20 days moving average, but it's going to go down and perhaps allow the 20 days to catch up with it. So we have to see, number one, loss of 188.57, and then we can speculate at what support line will Apple stop and find support. On the weekly chart for the Big Kahuna, what do we see here? We had a descending, sloping line of resistance, broke above it, closed above the 20 weeks moving average. All of this is bullish. Here's the problem though. We're going to pull back. The pullback, is it going to stop at the 20 weeks moving average? So far, so good. Are we going to lose the 20 weeks moving average? That's going to become concerning. And then the question becomes, where do we stop? So the 20 weeks moving average that's sitting right now at 181 is a really important number to keep in your chart. Microsoft daily chart, what do we see here? A lot of you have puts on this one. I do. What do we do right now with OpenAI and Sam Altman? Notice the behavior of the chart. We know it's absurd. It got way outside of the upper Bollinger Bands, way overbought. We got all of that. Fine. But the behavior of the chart keeps 367.35 as support. So we know that this is a point of capitulation. In other words, it is being kept as support here, retested 3 times, and the chart keeps knocking and knocking and knocking at this support line. And it finds support, and the support is algorithmic right now. What if it breaks that support though? Then we will see a lot of capitulation, a lot of rushing to the exit door at the same time, and it could produce a sizable reaction to the downside in Microsoft. Look at how far it is from the mean, the 20 days moving average. Of course, seldom when we see big flush downs all the way down to the mean of the 20 days moving average. It is possible, but not the likely scenario. The likely scenario is once we break 367.35, Microsoft will flush down, 2-3% sure, and then it might find support above the 20 and allow the 20 moving average to catch up with it. If we use the Fibonacci retracement levels here, we find that 360.56 is probably a good number here to find some support. So if you got Microsoft puts, once you lose 367.35, that will be a confirmation for you to double down, average down, do whatever you need to do here. But once you get to 360.56, you're probably going to find support at that point, absent of NVIDIA bombing. If NVIDIA bombs, then all possibilities are back on the table again. For all you know, Microsoft could lose the entirety of the 20 moving average altogether, but that's only if NVIDIA bombs. If we look at the weekly chart for Microsoft, what do we see here? We talked about this before, folks. It cannot sustain a pop outside of the Bollinger Bands on a weekly chart. The risk becomes predominantly for a pullback. The higher the extension is, the bigger the pullback. So right now, the assumption is we're going to see a sizable pullback here in Microsoft, be it because of the Sam Altman news or NVIDIA, or it just could be the technicals playing out. A lot of the holders of Microsoft look at the chart and say, whoa, that went way too far, too high in a short amount of time. The OpenAI news, I don't like any of that. NVIDIA is too much of a risk right now. Why not just pull the trigger here, book some profits, and that produces a pullback. And by the way, the last time we've seen this look was back in 2020. We got an outside divergence outside of the upper Bollinger Bands on the weekly chart, and then we all know what happened, the crash. Not saying Microsoft is going to crash right now, but when you get outside of the upper Bollinger Bands, you're going to get a sizable pullback to the mean. And the mean is the 20 moving average. On the daily chart, it's the daily moving average. On the weekly chart, it is the weekly moving average. How about Tesla, the souffle? Daily chart, what do we see here? Number one, we talked about this as the catch-up trade. And a lot of you bought some calls on it this week, and we did pretty good with it. But the target was, and I told you this when it happened, I told you that once you close the gap at 242, you want to book some profits here. Once we got there, folks, we got outside of the Bollinger Bands, we pulled back to 230.61. What do we do from here? What if this is just a pullback in an ABC pattern, which will go all the way up to reach the upper line of the channel? That is a possibility. So if you're going to chase any Magnificent 7 this week, I would say Tesla is the best one. However, if it loses the support at 230.61, forget about it. We have downside risk here. Why? Look at the weekly chart. We got a rebound. We got outside of the Bollinger Bands in the weekly chart. So we got a rebound, and the rebound got us to the 20 weeks moving average. What if this is the final and intended destination from the rebound to continue the pattern of lower highs and soon enough lower lows? That's the risk that you got to be mindful of. So the 20 weeks moving average right now is sitting at 244.79. You probably want to see a pass above that number before you buy again. And here it is, the talk of the town and the most important stock to watch this week, NVIDIA. Weekly chart, what do we see here? The chart passed the 20 weeks moving average. It is now back at the highs at around 502.66. Double top? Sure. Crash from here? Sure. An explosion higher from here? Absolutely. Who cares? All possibilities are open right now. It all depends on the fundamentals and the reception of the fundamentals. All I got to say here is, last time around, NVIDIA came out with a superb outlook, $16 billion, and the market didn't like it. The market went down either way. The stock went down either way. What is the requirement here for NVIDIA to make a higher high? If $16 billion in one quarter alone is not enough. In other words, folks, I'm telling you that the bar is way too high, and NVIDIA needs a massive beat to pass the highs again. In other words, the risk is to the downside here. This is a double top, and folks who in the last earnings report held through the correction and the pullback, now they have to think. We're back to even now. I bought at the highs last time around. I'm back to even right now. Do I need to be cute here? What is the risk that this is going to flush down? These are the kind of psychological questions that will happen by the holders. And I think if NVIDIA bombs, it's not only going to mark the top in NVIDIA, it's going to mark the top and the end of this market altogether. Lastly, tulips, Bitcoin, daily chart, what do we see here? Has a lot of momentum behind it. But of course, when you get outside of the upper Bollinger Bands, you're always going to see somewhat of a pullback. Right now, Bitcoin is pulling back in an orderly fashion, meaning it goes down to the 20 days moving average and it bounces higher again. What we see right now, at least at the time of the recording of this video, is a bear flag pattern combined with negative divergence on the RSI. In other words, the risk is if we break the 20 days moving average, Bitcoin could flush down big. So long as we're above the 20, we're okay. Once we break the 20, we got a problem here. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday the 20th, we have U.S. leading economic indicators. We also have from Richmond, President Tom Barkin. Tuesday, November 21st, we have existing home sales, and then we have the FOMC minutes from the last meeting. Wednesday, the 22nd of November, we have initial jobless claims. This is going to be highly important now as we monitor the degree of weakness in the employment market. We also have durable goods, and we have consumer sentiment. This is going to be the final reading. On Thursday, we have nothing. We got Thanksgiving. Happy Thanksgiving. Enjoy the turkey. And then Friday, November 24th, Black Friday. It's going to be a shortened day, so half a day, but we have important data coming out from the services and manufacturing PMIs. We're going to cover it all, folks, so stick around here. This is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
There's no earthly way of knowing
He's singing.
which direction we are going.